For much of the last decade, excess cash on corporate balance sheets was often viewed as a problem. It was labeled inefficient, unproductive, or a sign that management lacked confidence in growth opportunities. Companies were encouraged to deploy capital aggressively, return it to shareholders, or leverage balance sheets to accelerate expansion. In 2026, that mindset has decisively changed. Across the U.S. economy, firms are building more financial buffers than ever before, and this shift reflects a fundamental rethinking of risk, control, and long-term survival. Financial buffers include cash reserves, short-term liquid assets, unused credit lines, conservative leverage levels, and balance sheet flexibility that allows a company to absorb shocks without immediate disruption. What once looked like caution now looks like competence. U.S. firms are no longer optimizing for ideal conditions. They are optimizing for resilience in an environment where volatility has become the norm. One of the most important drivers behind this shift is persistent uncertainty. Economic conditions no longer move in clean cycles. Interest rates change faster. Input costs fluctuate unexpectedly. Demand can soften or surge with little warning. Geopolitical events, regulatory changes, and supply chain disruptions overlap instead of occurring in isolation. In this environment, forecasting accuracy has declined. Financial buffers act as insurance against being wrong. Higher interest rates have amplified the importance of internal liquidity. When capital was cheap, companies could rely on debt markets to bridge temporary shortfalls. Refinancing was assumed to be available. That assumption no longer holds. Borrowing is more expensive, and access to capital can tighten quickly. Firms are responding by reducing dependence on external funding and increasing their ability to self-finance during stress. Recent experience has reinforced this behavior. Many companies watched peers struggle when liquidity dried up. Businesses with thin buffers were forced into emergency fundraising, asset sales, or abrupt layoffs under unfavorable conditions. Firms with strong reserves maintained control, protected operations, and even gained market share while competitors retrenched. That contrast reshaped boardroom priorities. Another key reason firms are building buffers is the rising cost of operational shocks. Disruptions today tend to be systemic rather than localized. A supply chain breakdown can simultaneously increase costs, delay revenue, and damage customer trust. Regulatory changes can require sudden investment in compliance, systems, or staffing. Financial buffers give companies the ability to absorb these costs without derailing strategy. Investor expectations have also changed. Shareholders are placing greater emphasis on balance sheet strength, cash flow durability, and downside protection. Markets have become less tolerant of surprises and more skeptical of aggressive leverage. Firms that demonstrate strong liquidity positions are often rewarded with greater confidence and lower volatility. Buffers are now seen as a signal of disciplined management. Financial buffers also improve decision-making quality. Companies operating with minimal liquidity are forced into reactive behavior. Every setback becomes urgent. Long-term strategy gives way to short-term survival. Firms with adequate buffers gain time. Time allows leaders to evaluate options, negotiate from strength, and choose the least damaging path rather than the fastest one. Capital allocation decisions increasingly reflect this mindset. Instead of deploying every available dollar into growth initiatives, companies are intentionally setting aside reserves. Projects are evaluated not only on expected returns, but on how they affect liquidity and resilience. Some investments are delayed or phased to preserve financial flexibility, even if they look attractive under optimistic assumptions. Workforce strategy has been influenced as well. Companies with financial buffers can avoid reactive layoffs during downturns. They can retain talent, preserve institutional knowledge, and recover more quickly when conditions improve. This stability reduces long-term costs associated with rehiring, retraining, and rebuilding culture. Supply chain redesign has further encouraged buffer building. Firms are holding more inventory, diversifying suppliers, and investing in redundancy. These choices often require upfront cash and ongoing working capital. Financial buffers make it possible to prioritize reliability over maximum efficiency without jeopardizing solvency. Regulatory and compliance uncertainty also plays a role. New rules around labor, data, AI, environmental standards, and reporting can impose unexpected costs. Firms with limited liquidity struggle to adapt quickly. Those with buffers can absorb compliance expenses without sacrificing core operations or strategic initiatives. AI investment adds another layer of complexity. AI projects often require sustained spending before returns are realized. Companies are cautious about committing to these long-term investments without sufficient financial cushioning. Buffers allow firms to pursue innovation without putting short-term stability at risk. Importantly, building financial buffers does not mean companies are abandoning growth. It means growth is being pursued with guardrails. Firms want to ensure that expansion does not leave them exposed if conditions deteriorate. Buffers provide room to be ambitious without becoming fragile. This shift has changed internal performance metrics. Leaders are evaluated not just on revenue growth, but on liquidity management, cash flow predictability, and risk exposure. Financial discipline is no longer a constraint imposed by finance teams. It is a leadership responsibility. There is also a cultural change underway. For years, bold spending was equated with confidence. Today, restraint is often interpreted as competence. Executives who prioritize resilience are seen as responsible stewards rather than overly cautious managers. This reflects a broader maturation in corporate governance. In 2026, U.S. firms are building more financial buffers because they have accepted a hard truth. The future is less predictable, and the cost of being unprepared is high. Buffers provide flexibility, credibility, and control in an environment where shocks are frequent and often overlapping. Why U.S. firms are building more financial buffers than ever before ultimately comes down to one idea: control. Companies want control over their decisions, their timelines, and their responses to uncertainty. Cash, liquidity, and conservative balance sheets buy that control. In a business environment where conditions can change quickly and external support cannot be assumed, financial buffers are no longer excess. They are essential infrastructure. And for U.S. firms focused on long-term survival rather than short-term optics, building those buffers has become one of the most important strategic choices they can make.